Welcome back to my YouTube channel, guys. Okay, so in this video, I'm going to be explaining to you liquidity and inducement, the differences of liquidity and inducement, the similarities, how you can find them in the market, how you can discern them, how you can trade with them in the market. If you're new to this channel, don't forget to hit the subscribe button and turn on the notification bell to be notified whenever I drop any video. So back to liquidity and inducement. A lot of people has said a lot of things about inducements and liquidity. A lot of people said there's similarities between liquidity and inducement. Some people said there's differences, like a lot of differences. So I'm just going to be giving you an explanation based on what I have experienced in the market, based on what I have seen in the market, and the knowledge I have gained in the market. I'm going to be explaining to you based on that, guys. So when we talk about liquidity is not just inducement, but inducement is an aspect of liquidity. Liquidity is not just focused on inducement, but inducement is just an aspect of liquidity. When we talk about liquidity has a lot of definition, liquidity has a lot of types, liquidity has a lot of classification. But when we talk about inducement is part of the definition of liquidity. It is just an aspect of it. You will see in liquidity, we will have some people say buy side liquidity, some people will say sell side liquidity, some people will say external liquidity, major liquidity. We have inducement also as a classification of that liquidity. So you shouldn't be confusing liquidity with inducement. You shouldn't be confusing both of them together. You just have to know that inducement is just a part of liquidity. And when we talk about liquidity, basically liquidity is money. And liquidity is always used to fuel the market. Liquidity is always used to fuel the market movement. And also you need to know the expiration of liquidity. Perhaps when we have a fuel of a particular move, when the market is fueling a particular move, you need to know the area where that move is going to get to, and that is where we help you in placing your TP. That's not what I want to explain, guys. So I just want to give you some things about liquidity and then inducement. While inducements are areas of the market where traders believe it is right for them to enter the market. I'm going to be showing you all of this on chart, and we are going to be doing it together. So that is why I have not marked anything on the chart yet. I'm just going to be showing you this on chart. We're going to be doing that together. So inducements are just areas where traders believe it is right for them to enter the market. Market is always bringing in traders, enticing traders for them to enter at a particular moment. They want them to enter at a particular move so that they can take out their stop losses. That is exactly what the market wants to do, so that it can take out their stop losses and then it will still move in their directions. Areas where you can see your inducement are swing highs and lows. I'm going to show you all of this on chart also. You can also see your inducement on trend lines. You can see your inducement on trend lines. You can see your inducement on other blocks, and you can see them on support and resistance. You see all of these levels are where you can see your inducement. And also, market is always seeking for areas of inducement daily. Market is always looking at areas where it can pick out inducements, where it can induce traders out of the market and still move in their direction, just to frustrate traders. That's what this inducement does. It is just to frustrate traders. Now, when we talk about liquidity, it represents how you can easily buy or sell a particular asset or a particular pair without it significantly impacting the price. Okay, you know, when you have a buy order and then you place your stop loss, when you have a buy order and then you place your stop loss, that stop loss simply means you are selling out. You are selling it out at a particular price. It is also someone else that will be buying that from you. Someone else will be buying your stop loss from you. Exactly. So if you have a sell order, your stop loss is a buy order. That's just what the market does. So let's just see inducement. I'm going to be drawing out areas where you can find your inducements. In as much as I've made a video on inducements, I've made a video on inducements. You can check it out on my channel. I'm going to be explaining to you guys how you can find out your inducements and where you can find them out. So I'm going to be using a sell scenario for this. Okay, so when we have a sell movement, you know, this is a break of structure to the downside. We have a break of structure to the downside over here. There's a break of structure to the downside. Traders will be looking forward to sell from this other block. There will be another block here where traders are looking to sell the market. Unfortunately, the markets will just do something like this, make a reaction, come back to another block, or let's say a supply. Markets will come back to a supply around this place that has not been tested, maybe a fair value gap or a supply that has not been tested. The markets will blow out this high and then come to a supply here, then make a continuation to the downside. In the area where you are expecting the market to go, the market will make a continuation for you. And then you start saying what is happening. We had a break of structure here at first before market coming to this area. Market does this a whole lot of times. You will definitely see it on currency pair. You will see it on synthetic. You're going to see it on crypto. Yes, you will see it everywhere. Market does it every time. Sometimes the market will come back here. Also, we have minor inducements. We have major inducements. That is the next video I am going to be making for you guys to know the minor inducements and then knowing the major inducements. So you have to subscribe to this channel so that you will be able to get notified whenever I drop those videos. Okay, so we have minor inducements and then we have major inducements. Major inducements always happen when we have our external liquidity taken out, while minor inducements always happen in between those structures. Okay, so let's just change this color to black so that it can be more visible for us. Now you can see what the market did over here. We had this high taken out. Why? Because market wants to use that as liquidity to fuel the market. Remember, I said when we talk about inducement, it's just an aspect of liquidity. Of course, when you enter for a for a sell at this area, when you enter for a sell at this particular area, your stop loss will be on this high. Let's change this to black also. When you enter for a sell movement at this area, your stop loss will be on this high. Your stop loss will be on this high. Once your stop loss is on this high, the market makers or the big guys of the market are seeking to take your stop loss out. That is, take your liquidity out. And immediately they do that, they will move in the direction you are expecting the market to move. And a lot of traders will actually think this is a break of structure to the upside. They will start looking for a buy movement at a demand zone here. And of course, markets might want to react at that demand zone, just give a little reaction to get to a supply zone that is more stronger than that demand zone, and then make a continuation to the downside. And then you feel the market is just being manipulative. Yes, this inducement is what market seeks almost every day. And immediately you see that we have a break of our external structure, you are expecting the market to come back and then take your inducements. We have types of inducements. I have made this video, guys. I have made these videos on my channel. You can check them out. Types of inducements, how you can recognize inducement. The next one I'm going to be making is the major minor inducements, where I'm going to be explaining to you guys how you can recognize all of that. Okay, so immediately we had a break of this low, the market comes back into the internal structure, pick out inducements, and then continue to the downside. A lot of traders would definitely want to buy here, want to sell. Sorry about that. A lot of traders would want to sell here for a continuation. Okay, a lot of traders might want to sell here for a continuation to the downside. You know, we have a particular demand zone here, we have a particular supply zone here. We have a supply zone here. A lot of traders would want to sell from this area, but markets will use that high as an inducement and then continue to the downside. So talking about inducement, it simply means we have a break of structure to the downside, then the market comes back and breaks structure to the upside again. And then you are feeling, oh, the market has broken structure to the upside. It simply means we have a buy movement. No, it does not mean we have a buy movement. Market can just be taking out inducement, take out traders liquidity. You see, when we talk about liquidity, it simply means those areas where market knows that this retail trader will place their stop losses so that they can easily buy from them or easily sell from them, and it is not going to change the price movement. So you have to know areas where you can see your inducement, areas where you can see your trend lines, you know, your swing highs and swing lows, your trend lines, your other blocks, your support and resistance. You have to know those areas where markets are waiting for retails to come. They want the retailers to come so that they can just take them out of the market. Okay, so let's have another example of that. Then I'm going to show you all of these things on chart, guys. So let's use a buy scenario for this. That's where we are going to be having our buy movements. Done, guys. So we can have something of this nature. Market creating series of liquidity. Okay, series of liquidity. Remember, liquidity simply means money. Liquidity simply means money, and inducement is just an aspect of liquidity. Now you can see this trend line. You can see this trend line being formed. Okay, so we have our trend line here. So we're going to be marking that out. We have our trend line here, of which all of these are actually range structures. If you have watched my previous videos on structures also, all these are just range structures. And then, you know, we use our range structures as liquidity most often. So we have our trend line liquidity here. A whole lot of traders would definitely want to buy from this area, just to buy from this area and then continue to the upside. These areas are liquidity build up. They are liquidity build up. We have a lot of stop losses on these lows. So these ones are liquidity build up. These are trend lines liquidity build up. And then you notice the market comes back, come to a particular demand zone we have here, and then it will continue as a buy movement. Remember, a lot of traders would want to buy from this area with the thought that we have our last break of structure to the upside over here. With the thought that we have our last break of structure to the upside, they would want to buy at that demand area, not knowing we have a more stronger demand at this low. We have a stronger demand at this low. You can see that the market took out all of their stop losses. So talking about money, you should look at areas of the market. You should be able to learn the classifications of liquidity. So inducement is just an aspect of liquidity. You have to know what inducement is. And most often, inducements are always in the form of primary inducement, secondary inducement, or your swing high and your swing low inducement. When we talk about the secondary inducement, you are waiting for the market to take out your external liquidity. This is our external liquidity over here. Check out my video on types of inducement, and then you're going to get everything I am talking about inducement. So we have our external liquidity takeout, and this was the high created. Let's delete this. This was the high created after we had our external liquidity taken out. This high was created after our external liquidity was taken out. So this is the high the market used as liquidity. The market used this area as inducement, took out a lot of liquidity, and then continued to the downside. We also have our primary inducements. Our primary inducements are always formed when we have our first break of structure. After our first break of structure, the high created after the first break of structure, that's our primary inducements. Most often, markets will come back, take out the high. It can take it out with just a little wick. The market can take it out with just a little wick, and then you're going to see a continuation to the downside. So you have to know all these areas of inducement, and you have to learn areas of liquidity. Sometimes we have areas of liquidity to be our double top, our double bottom, triple top, triple bottom, all of those things. They are also liquidity. So that is why you should know that inducement is also part of all of these things. So don't confuse inducement as the major liquidity. You need to learn more about liquidity. You need to learn more about liquidity. We have double top, we have sell side liquidity, we have buy side liquidity. Some people call the aunt of liquidity. Yes, we have aunt of liquidity, we have stop aunt liquidity, we have the inducement part, and all of those things. So if you want to learn about liquidity as a whole, you learn about liquidity. Don't just learn about inducement and feel that is just all about liquidity. You have to intensify more in the learning of liquidity. Which areas are stop losses? Where do we have these retail stop losses? When you want to trade like the big guys, you want to trade like the banks, you need to focus on where they are focusing. You need to see where retails are placing their trade. I have a friend that will always say that whenever you see a lot of channels, trying to buy a particular pair or trying to sell a particular pair, don't buy at that area. That will definitely be used as inducement, because a lot of people are focusing on that area of the market, and their stop losses are always above. Now, when you see anywhere retail stop losses are, that is where the liquidity are. That is where the market makers would want to buy or sell from, because they are just going to take their orders relentlessly. They will take it effortlessly, and then the market will move in your direction. Okay, so you have to know all of these things. You have to know all of this liquidity. One of these days, I'm going to just list out all of the liquidity we have. I'm going to list them out, and then I'm going to show you guys how you can recognize them. So let's go to chart so I can show you guys these things. Okay, I did not mark out any chart so that it's going to be very plain for you guys. We're going to be marking it together, and then you're going to be seeing me mark it. I have not marked them I've not marked them before. So I'm just going to be marking them in your presence, guys, and I'm going to be making an explanation of them. So let me just delete all of this and then go to chat immediately and give you an explanation of what I'm talking about. I'm going to show you guys the liquidity, the inducement, and all of those things. I'm going to explain them to you guys on chat right now, and then we're going to see them together. So let's just delete all of this. Okay. This deleted. All right, so this is volatility 25 index, and this is 24 hours time frame. This is 24 hours time frame. So I'm going to be making my explanation from this 24 hours time frame. Now, if you want to mark out your structure properly, ensure that you are marking it from higher time frame. And in fact, I'm going to advise that you use your MT5 for weekly time frame, because the REEF trading view only gives us access to 24 hours. We are limited to 24 hours over here. So we have our break of structure to the upside here. This is a break of structure to the upside. So we are definitely in a buy market. We're in a buy market. We're in a buy scenario. Now, I noticed that a lot of people marked this particular candle out. This is volatility 25 years. I noticed a lot of people marked this place out as the demand candle for a continuation. You can see it is the demand candle, and you can see the impulse movements we had. You can see the impulse movement we had away from this demand candle. So this demand candle is definitely valid. So let me show you what the market did eventually. The market took out that demand candle with a wick. It took out inducement, and it took out people's stop losses. I'm going to zoom out more for you guys to see. Can you see this little candle? Can you see this little wick outside that demand candle? Now, what did the market do in this scenario? We have an inducement. We have a break of structure to the upside, okay? We had a break of structure to the upside. Okay? After the break of structure, the next low created, the low created immediately after break of structure was this low, this particular low. Don't worry, guys, I'm going to give you an explanation of major and minor inducements in another video I'm going to be dropping next. You can see this was the low created immediately we had our first break of structure, and immediately the low was created, the market gave an impulsive movement. Okay, the market gave an impulsive movement. Sorry about that. So let's have this. So we had an impulsive movement to the upside, of which a lot of traders are seeing this area as demand area. Now see what the market did. The market took out inducement. The market took it out because it was the first high created immediately we had our first break of structure. That is an inducement, guys. See what the market did. We took it out, and of which a lot of traders stop losses are out already. A lot of traders stop losses are out already. If we check other time frames, let's just check okay, let's check our 4 hours time frame. You know, this is 8 hours time frame, this is 24 hours time frame. So let's just check the 2 hours time frame, and then you'll notice that this particular week has taken out a whole lot of traders. It has taken out a whole lot of traders with just that week. Just that week has taken out a lot of traders. Okay. Can you see this, guys? Can you see this? This is 2 hours time frame. This is 2 hours time frame. Just that particular week has taken out lots of traders. It has taken out their stop losses. That is liquidity. You see, wherever you see that money resides, wherever you see that trader stop losses reside, it is liquidity. So liquidity is money. So where are the traders' money? Where do we have the traders' money? Anywhere you see we have the traders' money, that is where liquidity is. Now, inducement is an aspect of which traders' money resides. Inducement is an aspect of which traders' money resides. So inducement is just an aspect of liquidity. Inducement is just an aspect of liquidity. So you have to learn more about liquidity. Don't just learn more on inducement, only inducement. You are learning about inducement. What about other parts of liquidity? You know, we have ons of liquidity, we have stop ons. We have stop on liquidity. That is when we have double bottom, double top, the market coming back to raid all of those things, market creating a fuel of the market creating a high or a low. It will come back to ons and then make a continuation either to the upside or to the downside. So let's just talk a little more about inducement here, and then let's see how far we can go with that. Okay. You guys really need to see the minor inducements and the major inducements, because that is exactly what happened at this area. We had a break of structure to the downside. So guys, just stay tuned and then wait for me to drop the minor inducements and the major inducements. You'll definitely enjoy it, and it's mind-blowing. And the market came back to this area. Done, guys. The market came back to a proper area of supply candle. The market came back to a proper area of supply candle. Now we've induced this particular high. This high has been induced. This particular one has been induced with this high. The market broke structure to the downside, and we had our major external liquidity here. We have our major external liquidity here, right? This is our external liquidity here. And you can say the market was yet to take this external liquidity, but we've taken out this low. We've taken out this low. After market took out this low, you can see what the market did. There was still an untested supply candle here. Market took it out. Trust me when I say a lot of traders have their orders here. A lot of traders would definitely have their orders here for a sell continuation. Why? Because we've entered this high. They will put their stop losses on this high. Stop losses will be on this high, this particular one. Our stop losses will be here. The stop losses will be here. And market did something different. Market took out this low, then came back and took out this our high, and then used a particular supply zone for a continuation. This area here, what happened at this area here is major inducements being taken. Major inducements being taken. I'm going to just explain that to you guys in another video. Just wait for that video. You see, a lot of things happened here. We had our break of structure to the downside here. You know, this is the external liquidity here, but we had a break of structure to the downside. The market came to our supply candle, taking out all other highs and all other swing lows. All other swing highs, the market just took out all those swing highs. We have that primary inducement here. This is a primary inducement over here. The market took it out and then made a continuation to the downside. You can see what happened here also. Same thing is happening at this area. We had same thing happened at this area. We had our break of structure to the upside. This is a break of structure to the upside. You can see markets did not come back into this internal structure, and we had liquidity build up. Check all that happened here, guys. This is liquidity build up. All these are just liquidity build up. If you watched my video on structure, I explained structure range. All of these are just liquidity build up. See what happened here. This is just liquidity buildup. Now, for someone that only knows about inducement, you just feel, oh, once market takes this area or once market takes a particular area, you just continue to the upside. That is why I told you guys that you should learn more on liquidity, things that happen in liquidity, more of liquidity concept. You should learn more about it. You shouldn't just focus on inducement. You can see after we had break of structure to the upside, the market created all of this range structure. Range structure is also a part of liquidity. Range structure is also an aspect of liquidity, so you should know about that also. You can check my video for that. So we had this low created, the market broke structure to the upside. See what happened? We had a break of structure to the upside here. Check out a break of structure to the upside. The market came back, took out this liquidity, took out all of that liquidity, and then made a continuation to the upside. We had another break of structure to the upside. Now, let's not forget that we have a first break of structure to the upside here, and all others are just range structure. And we came back to pick out our range structure as a liquidity. Guys, we came back to pick our range structure as a liquidity. So you should know about liquidity. You should know about it. Don't just take liquidity for fun. So a lot of traders would definitely want to continue from this area. From this area, there's a demand candle around this area that would want to continue from this area to the upside, neglecting that we had our first BMS here and we are not at the internal structure yet. We've not tested the internal structure yet. So the market came back and took out all other stop losses. It took out stop losses. Anyone entering from this area, definitely your stop loss will be at this low. Anyone entering at this demand zone, your stop loss will be at this low. Okay, market took out all those stop losses and then made a continuation to the upside. And you can see that we had a very good buy to the upside. We had a very good buy. Immediately we had our liquidity taken. Now, you should know this. Once market takes out a particular liquidity, the market will move impulsively. The market will move in a very impulsive way. Once it takes out the liquidity it is searching for, the market will be running. It's going to have a very impulsive move once it takes liquidity. Now, after the market took out all of this liquidity, as I said earlier, where the market is targeting is this high. That is how you should know where you should be placing your stop losses and where you should place all other things and your take profits. Okay, so this is where the market is running to break this particular high. The market is running to break this high. Immediately we had those liquidity take. The market is running to break this high. Immediately market break this high, I think you should be out of the market. You would have done a very good risk to reward. You would have done a good risk to reward. So that's going to be all about that, guys. I'm going to see you guys in the next video. I'm going to be dropping another video that consists of the minor and the major inducements. I'm going to be dropping it very soon. If you have any question, let me know in the comment section, guys. Keep living in the atmosphere of profits. Bye, guys.